Most people think money moves through the modern financial system in a pretty simple way. You get paid, you deposit money in the bank, and the bank keeps some of that money and it lends the rest to someone else. And that process continues. But what if I told you that's not actually how it works? Because banks, they don't need to keep a portion of your deposit in order to lend it out. And when a bank makes a loan, it doesn't lend someone else's deposit. It literally creates new digital money out of thin air, and it's allowed and regulated by the government to do that. This would mean that the modern financial system isn't really about moving money around, it's about creating credit. And that one idea explains why economies can grow so fast and why financial crises happen over and over again. So the first thing you have to understand is that the financial system is basically infrastructure. It's the network that moves money, credit, and risk between people, businesses, and governments. And at its core, it does 5 main things. First is payments, moving money from one person to another. Things like paychecks, bills, card payments, wire transfers, all of that. Next is credit creation. That's turning bank balance sheets into loans for households and businesses. And third is maturity transformation. This is where banks fund long-term loans like mortgages using short-term money like deposits. Fourth is risk transfer. Investors can buy and sell risk through things like bonds, stocks, and derivatives. And fifth is price discovery. This is when financial markets help determine interest rates that guide investment decisions across the economy. But the financial system isn't just one institution. It's layers of markets and institutions all connected together. Things like banks, investment funds, dealers, treasury markets, repo markets, and all of it starts with one simple fact most people don't understand. There are actually 2 different types of money in the financial system. The first type is central bank money. This is money created by the Federal Reserve. It includes 2 things, physical cash and bank reserves. It's basically the money banks hold in accounts at the Federal Reserve, but you don't use this type of money for everyday life. When you pay for groceries, send money to your friends, or you get paid from your job, you're not using central bank money. You're using the second type of money, which is commercial bank money. This is money in your checkings account, your savings account, your bank balance, and these are called bank deposits, and almost all spending in the economy happens using these deposits. But where people get confused is when you see $10,000 in your bank account, it feels like the bank is holding $10,000 somewhere for you. But that's not really how it works. Your deposit is actually now a liability for the bank because now that you deposited the money into the bank owes you that money. But obviously the bank doesn't just keep it sitting there. It turns that money into something else like loans or it purchases securities. And that's where your money gets turned into an asset for the bank. But that system has some built-in fragility. Now, to touch back on something we talked about earlier, most people think banks work like this. Someone deposits money, the bank keeps some of it, and then it lends the rest to someone else. That used to be the common explanation, but that's not actually how modern banks work anymore. In March 2020, the Federal Reserve, it removed reserve requirements for banks. That means banks, they don't have to keep any fixed percentage of deposits sitting in a reserve. They can essentially use all of their deposits to make loans or buy assets. But that doesn't give you the full story on how loans work. When a bank makes a loan, it doesn't take money from someone else's deposit and give it to you. It actually creates new money. Let's say you walk into a bank and you take out a $50,000 car loan. The bank doesn't just go into a vault and grab $50K or transfer it from another account. Instead, it simply just adds $50K to your bank balance. Your account suddenly shows plus $50,000. That money, it did not come from another customer. It was created by the bank when the loan was issued. And at that exact same moment, something else appears on the bank's books. You now owe the bank $50,000. So the bank has an asset, the loan you have to pay back, and it has a liability, the deposit it just created for you. That's how the modern banking system works. Loans actually create deposits, and every time the bank lends more money into the economy, the money supply grows. And when spending slows or loans get paid back, the money supply shrinks. That's why credit cycles drive the economy. When credit is easy, spending rises and asset prices rise, and there's so much money in the system, everyone feels rich. And when credit tightens, spending falls and asset prices fall, so the system expands and contracts with lending. Now that you understand how loans create money, we can look at how a bank actually works. A bank basically has three parts on its balance sheet. Assets, these are things the bank owns or is owed, and it's mostly mortgages, business loans, credit card debt, government bonds, or reserves held at the Federal Reserve. But out of everything, loans are the largest assets banks hold because loans generate interest income. The next thing on a bank's balance sheet is liabilities. These are things the bank owes to other people. And the biggest one is deposits. That includes your checkings account and your savings account. From your perspective, that money is an asset to you. But from the bank's perspective, it's actually a liability because the bank owes it back to you whenever you want it. The third thing on a bank's balance sheet is capital or equity. It's basically their assets minus their liabilities. This is the bank's own money. It's the money invested by shareholders, or it's the bank's profits at the end of the year, and capital acts like a shock absorber. If loans go bad and the bank takes losses, those losses come out of its capital first, and that protects depositors. But here's the problem. Deposits can leave the bank very quickly. If customers panic and withdraw their money, the bank suddenly needs cash. But the bank's assets, like mortgages and long-term loans, they can't be sold instantly. And if they are sold quickly, they may have to be sold at huge losses. That's why banks can collapse even if their assets are technically worth more than their liabilities, because the withdrawals can happen faster than the assets can be sold. And that's exactly what's happened in bank runs throughout history. And it's also why the government, it created two backstops. The first is deposit insurance called FDIC, and it protects depositors up to $250,000. Second, the Federal Reserve Central Bank, it acts as a lender of last resort to banks that are getting a lot of withdrawals because if depositors panic across the system, the entire financial system can freeze in hours. Now, to really show you guys how this works, let's follow what happens when money moves through the financial system step by step. Step one, you get paid. Your employer sends you $1,000, your bank credits your account, and you see $1,000 on your balance. But behind the scenes, something else happened. If your employer uses a different bank than you do, the bank settles the payment using reserves held at the Federal Reserve. So one bank's reserves go down and the other bank's reserves go up. You never actually see reserves, but they're what banks use to settle payments with each other. Step two, you spend the money. Let's say you use that $1,000 to pay rent. The payment might go through a card network, an ACH transfer, or a wire payment, but eventually the same thing happens again. Reserves move between banks to settle the payment. That's the base layer of the system. Step three, banks don't just hold deposits. They use them to make loans or buy assets. So if your bank receives deposits, it might use them to issue a mortgage to someone buying a house, and the bank earns interest on that loan. That's one of the main ways banks make money. And step four, this is kind of a weird one, is that loans connect to global investors. In the US, a lot of mortgages, they don't stay on a bank's balance sheet. They get bundled together into something called mortgage-backed securities, and they kind of turn into an asset, and they sell them to investors, pension funds, insurance companies, mutual funds, even foreign governments buy them. So a household taking out a mortgage in Ohio can end up being financed by investors in China. And step five, the Federal Reserve influences the whole system. The Fed doesn't directly control mortgage rates or stock prices. Instead, it sets short-term interest rates for the banking system. So when rates rise, borrowing becomes more expensive. And when rates fall, borrowing becomes cheaper. And because credit flows through the entire financial system, those changes affect everything, including the housing market and even startup funding. And that's how money actually moves through the financial system. Deposits, loans, capital markets, and central bank policy, they're all connected through the bank balance sheets. So now that we have a clear understanding of the financial system, we have to talk about some of its drawbacks, because a lot of incentive in the system actually pushes it towards risk. The first risk is banks borrow short term, but they lend long term. So yes, most bank deposits can be withdrawn anytime, but the loans banks make, like mortgages, they can last 30 years, and that works fine most of the time. But if too many people want their money back at once, the bank can't quickly sell these long-term loans, and that's how bank runs happen. The second problem is bank profits are private, but their losses become public. When banks take risks and things go well, shareholders and executives, they keep all the profits. But when the bank makes a mistake and the entire system is in danger, governments and central banks, they often step in and stabilize it. That safety net helps prevent economic collapse, but it also creates something economists call moral hazard. Basically, it means if the worst outcomes for banks are always cushioned or they're always getting bailed out by the federal taxpayer, there's a kind of incentive to take as much risk as possible because the federal government will always step in to pay it. And the third risk is leverage amplifies everything. When you use borrowed money, yes, it can boost returns, and when asset prices are rising, you feel rich. But it also magnifies losses when prices fall. And when competitors are using leverage to generate higher returns, it becomes difficult for firms to stay conservative. And the fourth risk, and this is a big one, is short-term incentives. Many traders and executives get rewarded based on short-term performance. That can encourage decisions that look good in the short term, but they create a lot of risks later on. But they don't care because they want to get paid now and they want to get paid the most. And finally, the system relies heavily on financial plumbing working perfectly. Markets like the treasury market and short-term funding markets, they keep money flowing through the system. But if those markets freeze or stop functioning smoothly, the effects can spread very quickly. This is why central banks, they have emergency tools ready, because when the plumbing breaks, the entire system can collapse very fast. So the modern financial system, it isn't really about moving money around, it's about creating credit. And banks actually create deposits when they make loans. And those loans turn into spending, investment, and asset prices rising across the economy. And when credit expands, the economy grows. But when credit tightens, the whole system can slow down very quickly. Because the system is basically built on confidence. Confidence that deposits are safe, confidence that borrowers can repay their loans, that markets will keep functioning. And majority of the time, that confidence holds. But if it breaks, that's when financial crises happen. And once you understand that, you start to see the financial system very differently. Not like a machine that moves money, but more like a system built on credit, leverage, and trust. And that combination, it's incredibly powerful, but it's also inherently fragile.